Hello and welcome to our webcast, Rating ILS Affiliated Collateralized Reinsurers. AM Best Analysts will examine how they rate ILS Affiliated Collateralized Reinsurers. Reinsurers of this type are relatively new, but are expected to become a larger share of the reinsurance sector as they seek greater operational efficiency, elimination of fronting fees, and more flexibility in tailoring their offerings to cedents. Now, we will be mentioning the subject of financial strength ratings. A full explanation of AM Best ratings is available online at ambest.com/terms. If you have a question or comment, you can send it in to us at webinars@ambest.com, and we're going to do our best to recognize it during our program today. Presenting for today's webinar are Emmanuel Modou. Manny is the Managing Director of AM Best, and Dr. Y. Tang, Director at AM Best. And at this time, we'll turn things over to Manny Modou. Manny?
Thanks, John. Once again, my name is Manny Modou. I'm Managing Director at AM Best. I'll be joined by Dr. Y. Tang to discuss rating ILS affiliated collateralized reinsurers. We have 5 agenda items for this morning. The first item will be to discuss the ILS Universe, including the components of ILS capacity. Secondly, we'll discuss the ecosystem of the unrated collateralized reinsurers, which we call unrated CR. Then we'll discuss the business model of rated collateralized reinsurers that we see out in the market, which we call rated CR. And then we'll talk about the rating process, specifically the use of our best credit rating methodology. Finally, we'll talk about some of the more important rating considerations specific to rating CRs. Let's begin with the ILS Universe. The capacity provided by the ILS market is currently at about $98 billion, which consists of 4 components. The fastest growing component is collateralized reinsurance, which is approximately $55 billion worth of capacity. The next biggest is the cat bonds, which is about $30 billion worth of capacity. And sidecars and ILWs round out the $13 billion worth of capacity. This is a table of the top 10 specialist ILS fund managers. You notice that in July 2000, if you compare the numbers in July 2018 and March 2019, you see that there's a diminution in AUM of about $2 billion or so. And that's kind of an indication that some investors have pulled out of the market due to the cat events of the past couple of years. You notice that CATCo is no longer on this list. A couple of years ago, it would have been on the list, but it's dropped out due to its well-publicized issues. Also not shown on this table is the fact that you have some capital that's trapped and can't be deployed. So the number you see here does not mean that number is available to add capacity to the reinsurance market. The cat events over the past couple of years have exposed some of the strengths and weaknesses of the ILS market. On the strength side, you had orderly payment of losses by the ILS market and without any hitches because the collateral obviously is there to make the payments. Although the events did expose the loss creep issues and expose the fact that CRs, collateralized reinsurers, are not exactly equivalent to traditional reinsurers from a cedent's perspective. And that's because of the limited claims development period for CRs versus traditional reinsurers. And so what you have is tail risk that goes back to the cedents based on the limited claims development period. Also, CRs are not all created equal. Some may be more accommodating to cedents than others when claims develop beyond projections, even if they're not contractually required to do so. The quality of cedents matter greatly as well with respect to reserving acumen. For example, some of the Florida insurers have experienced extreme loss creep, which is a bit disturbing for some of their reinsurers. The type of business ceded to CRs also matters. Retro business, for example, has a longer loss development period than regular reinsurance because of the information flow, because of the difficulty in getting information from the original cedents, for example. Let's now talk about the unrated CR. On the right-hand side, you see the ecosystem of the collateralized reinsurer. It consists of 4 major categories. Number one, you see the investment manager at the top, which acts as an underwriter for the reinsurance transactions between the cedents and the transformer. The investment manager also negotiates with cedents, solicits funds from investors, and also, but is not a risk bearer at all. So it takes no risk in these transactions. The next category of segment is the funds themselves. The funds themselves provide the collateral for the reinsurance transaction between the transformer and the cedents. And they do this through funding agreements, also known as subscription agreements. And the funding agreements defines the terms of the funding to the transformer to collateralize the agreements between the cedents and the transformer. The transformer itself is a counterparty to the reinsurance transactions, and it's generally lightly regulated and has a very limited capital in most cases. And I believe for the SPIs, the capital is probably about $1 million or so. So in Bermuda, the transformers take the form of special purpose insurers, Class 3, Class 3A, and Class 3B reinsurers. Item 4 you see there on the right-hand side is the collateral trust, of course. And these are generally trusts that are similar to NY Regulation 114 trusts. The trusts, of course, are funded at inception of the reinsurance agreements between the cedents and the transformers. And as I mentioned earlier, the funds are provided by the funds themselves. The trust agreements are between the cedents, who are the beneficiaries, the transformer, who are the grantor, who is a grantor, and the banks, which are generally the trustees. This is a simplified diagram of that ecosystem, so to make it easier to review. You can see on the left-hand side the cedent interacts with the transformer. The interaction could come in the form of the cedent could interact with a segregated account or with the transformer itself. And we'll give you more details later on about that. Let's now talk about the rated CR. We call the rated CR NUCO Re, and there are several motivating factors for a rated CR. The first factor is the elimination of fronting costs. Fronting fees can range from between 5 and 15% of premiums, depending on how much leverage the investment manager is seeking in the transactions. Also, the rating can also eliminate dependence on fronting companies, and thereby avoiding some of the fronting dislocations in the fronting market at this point. Right now, there are 3 major fronting companies. You have Hannover Re, Allianz, and TMR. But TMR has announced recently that it will no longer be in the fronting business due to its acquisition by RenRe. So therefore, you've got an elimination of one of the major fronters, which is a problem for some of the investment managers in the ILS space. So therefore, they want to eliminate that dislocation. So starting their own NUCO Re, which is effectively a fronter, is their solution. Also, the ILS managers want to reduce inefficiencies associated with having many trusts and LOCs. You can have scores of trusts and many LOCs, and it's kind of an operational nightmare for these investment managers. In addition, a rated entity helps create some leverage, because with a rated entity, you don't need to hold 100% collateral. Most of the collateral will be ceded to a transformer, but the ones that most of the risk will be ceded to the transformer. The risk that's retained by the NUCO Re is not fully collateralized, so that provides some leverage. In addition, what we have with a rated CR, NUCO Re, is increased flexibility to provide reinsurance solutions. And these solutions could be solutions related to reinstatements, aggregate transactions, and other forms of reinsurance that are not readily available through the unrated CRs. Also, another motivation is that some cedents can only transact with rated entities. So having a rated entity opens up the collateral managers to soliciting business from cedents that will not otherwise be interested in their business. AM Best classifies three companies as ILS affiliated collateralized reinsurers. The first one is Kelvin Re Limited. We rated Kelvin Re September 2014, and the capital for Kelvin Re was provided by Middle Eastern Sovereign Wealth Fund, and the source of business is primarily through CS insurance-linked strategies. Kelvin Re has an alternative asset investment strategy, and its leverage, as measured by net written premiums over surplus, is moderate. The second reinsurer in this space that we rated that Humboldt Re in October 2015, and the capital for Humboldt Re was provided by a Swiss pension fund. And once again, the business here is sourced by through Credit Suisse insurance-linked strategies. Humboldt Re has a low risk investment asset strategy, and its leverage is also quite low, as measured by NWP over surplus. Luma Re was first rated in December 2017, and the capital was provided by one of the LGT funds, and the source of business is LGT ILS Partners. Luma Re has a low risk asset investment strategy and extremely low leverage, whether measured by NWP over surplus or limit over surplus. Kelvin, Humboldt, and Lumen are rated A-, A-, and A respectively. This is just the common business model that we see for NewCo, the newly rated entities. And you see NewCo is in orange. Item 1, the cedent has a reinsurance contract with NewCo Re, is either a reinsurance or retro agreement. NewCo Re, in the middle, generally retains a small amount of risk and cedes the rest either to a transformer through variable quota share agreements or through to a rated reinsurer, also through a variable quota share agreement. The transformer can fully collateralize its obligations to NewCo Re if it so chooses, but it can also collateralize up to a certain PML level. That collateral is provided by the funds through funding agreements, as you see in item 4 to the right-hand side. The collateral is provided by the funds, and the funds, of course, are deposited to the collateral trust to secure the agreement between NewCo Re and the transformer. Item 6 there you see is simply the tri-party trust agreement between the NewCo Re, which is the beneficiary of the trust, the transformer, which is the grantor of the trust, and the trust itself, which is the trustee, I guess, which is with a bank that's involved in the agreement. Item 7, all the way to the left-hand side, is just a trust that are arranged for cedents who don't really care about rated paper from, say, NewCo Re. So therefore, cedents can have their obligations still fully collateralized and operate the same way as they would operate if the reinsurer, if the NewCo Re was if the transformer was still in play for them. Let's now talk about the rating process. I'll now turn this over to Dr. White-Tang to talk about the rating process.
Thank you, Manny. So let's go into this rating process. First, as usual, the main methodology for rating our insurance companies is the best credit rating methodology, BCRM. Other than that, there are several very important criteria that actually has to be included in this rating process. The first two criteria listed here discuss about the BCAR, that is the best capital adequacy ratio, which is a quantitative measure of the risk of the company relative to its available capital. The third criteria here talks about cat risk stress, which is second event cat stress, where the loss is applied directly to the capital rather than appear in the negative required capital formula. The fourth criteria is the calculation of equity credit for different types of capitals, so such as common stock or hybrid-like preferred stocks. The fifth criteria, rating new company formation. Here we are basing on this criteria to classify if the entity seeking rating is a new company or not. If the company is classified as a new company, there are certain constraints on some of the building block assessment. The last two criteria discuss about the tail risk back to the new code from the transformer and the treatment of that. All this methodology and criteria, you can find it in our website, in the underlined slide here. Oh, what's going on? Sorry. Next, we're talking about the approach. Our approach for rating of an insurance company is building block approach. Total, there are 6 blocks. In general, only the first 4 blocks is applicable to CR. The last 2 blocks usually is not applicable. Balance sheet strength is the first block. It usually is viewed as the foundation of the financial security. One of the components of balance sheet strength is BCAR. Other than BCAR, there are other quantitative and qualitative factors in the assessment of the balance sheet strength of the entity. BCAR we will evaluate at different VAR level, 95, 99, 99.5, and 99.6 percentile. The second and third blocks, operating performance and business profiles, concerns about the well-being of the balance sheet strength of the entity in the future. Without solid operating performance and business profile, a company's balance sheet strength will erode over time. So operating performance is a leading indicator of future balance sheet strength and long-term financial stability. So if we have a strong performance over time, that will generate earnings sufficient to maintain a prudent level of risk-adjusted capital. After the operating performance review, we'll assess the company's business profile, like the nature of the business itself, the market position, the distribution channels. Favorable business profile will typically translate into defensible competitive advantages. Enterprise risk management, ERM, is the fourth block. We will want to understand of the development and the implementation of the insurer's risk management framework and understanding of the insurer's risk management capability relative to its own risk profile. In this block, we will also calculate the BCAR with VAR level 99.8 percentile and want to see the trend of the BCAR number from 99 to the 99.8%. If there's a huge dip from 99.6 percentile to 99.8 percentile, there will be some concern then. In this slide, we show the BCAR formula. Here you see that there are 2 components in the BCAR formula, available capital and the net required capital. The numerator, you can actually interpret it as excess capital over net required capital. So basically, BCAR measure excess capital relative to available capital. The higher the BCAR number, the better. Let's go into the detail of the different components into these 2 available capital and net required capital. On the left-hand side, you see the components of the available capital. As expected, the major and most important one is the reported surplus. But there are some adjustments like the unearned premium, the loss reserve, that also will change the available capital. On the right-hand side, you will see the components of the net required capital, NRC. There are 8 of them. The first 2 are the asset risk. However, you have to bear in mind that in this case, the fixed income security risk in here is the credit risk of the securities only, not the interest rate risk. Interest rate risk of the fixed income is in the B3, the third component. B4, the credit risk, is the credit risk of reinsurance recoverable only. It does not include the credit risk of fixed income security. That actually is in the B1. B5 and B6 are the reserve risk. In normal circumstances, as the CR usually is engaged in excess of loss business and invest in a bit more remote layers, So reserve usually is more, and so is the reserve risk. However, in 2017 and 2018, we witnessed the historical cat loss event, and so the reserve in those 2 years are quite high, and so are the reserve risks. B8, the potential catastrophe losses, is the dominant component of the CR's net required capital, as one can expect. The rating process here, we are talking about this is the BCAR formula component. You can see that this is the famous square root formula of the net required capital. In the formula, you can see other than B4 and B5, there's no cost term between all the other risk components. That means we assume zero correlation among the risk components other than B4 and B5. For B8, we require, which actually, as I mentioned before, is the dominant term, we require the PML of the cat loss at various VaR level. B5, as I mentioned before too, this is the reserve risk after the cat event. B4 is the reinsurance recoverables. So how to interpret the BCAR number? Here, we want to focus on the first two rows. Remember BCAR, we calculate BCAR at several VaR levels. The first two levels are the BCAR at 99.6 percentile. Usually, the CR will fall into one of these two categories. If the BCAR at 99.6 percentile is greater than 25, the BCAR assessment is the strongest. If the BCAR at 99.6 fall into 10 and 25, the assessment is very strong. However, remember that BCAR is only one of the quantitative factors in determining the balance sheet strength. There are other factors in assessing the balance sheet strength. In the next slide, we will talk about that. In assessing the balance sheet strength, we will take a look at the BCAR score at the stressed and unstressed levels. High BCAR score definitely is positive. Other than that, we also will take a look at the leverage of the entities as related to the retained limits and the equity capital, whether it's low or high. Also, we will see if the entity itself has internal capital model or not. And also, we will see whether the investment portfolio is invested in highly rated liquid asset or illiquid asset. And also, the ceded business is highly collateralized or not there, or only collateralized up to maybe certain PML level, or the ceded business is into a rated entities. Next, we will talk about the operating performance. In this, we will try to understand the underwriting performance as measured by the loss ratio, expense ratio, and the combined ratios over time to see if this consistency and stable are better than the benchmark, whether this is inconsistent or volatile over time or not. The second one we will try to understand is the pricing strategy. Is it based on the underwriting guideline and clearly defined or not? These are only some of the factors we are talking about here, but actually there's much more than that. The business profile assessment here, we will see how the geographical spread of the risk incidents. Are they concentrated just in the Florida wind or actually diversify into, say, California earthquake or Japanese earthquake and wind or European wind? Also, we will try to see whether the risk they are taking can be modeled carefully by the vendor models or any third-party consultants, or there are some non-modeled risk. And what's the proportion of the non-modeled risk and the modeled risk? And the distribution sources, is it strong or weak? Do they have many different types of distribution sources, or can they actually access the system directly, or they only have maybe one or two distribution sources going through some brokers only? And also we'll see the business lines, are they correlated strongly or uncorrelated? In the business profile, as we this is a CR usually engaged in a cat risk. So the business nature itself is a kind of like digital. So it's somewhat constrained like other monolines in that sense, because this is like financial guarantors or mortgage insurers. So usually because of the digital nature of this business, the business profile usually is limited. The fourth building block is the ERM, Enterprise Risk Management. We'll see whether they do have a prudent ERM framework and infrastructure in place to support it. Do they have enough personnel to support that kind of ERM framework? What kind of risk appetite and tolerance do they have? And whether they're actually consistent and reflect the company's business profile. Do they have a strong governance policy, report systems in place? Are they actually doing their validation of risk metric frequently and do stress test results? This concludes the section of the rating process. Let me give it back to Manny to continue the important rating consideration sessions.
Thanks, Wai. So we're not going to talk about important rating considerations as they relate to rated CRs. We'll begin with the idea of permanent capital. The concept of permanent capital is absolutely important at AM Best. And for us, the most permanent of the capital is common equity, and that receives full equity credit in our analyses. When we're presented with hybrid capital, such as preferred stock or trust preferreds, we do apply haircuts based on certain features. Maturity features, of course, the longer the maturity, the less of a haircut. Call features, debt service features such as mandatory payments. If the payments are mandatory, it probably gets more of a haircut. Subordination level to policyholders, treatment by regulators, and management intent. If we substantially haircut our capital, it can affect greatly available capital and then affect greatly the BACAR scores, which ultimately would make balance sheet strength somewhat inadequate. So the idea of permanent capital is of absolute importance in our rating analysis. We don't require any type of capital. We don't have any guideline as to what kind of capital you ought to have, but just know that any hybrid capital would suffer severe haircuts. This is once again just a diagram that shows the rated entity NewCo Re and all its components and all the entities that it interacts with. I just want to point out a couple of things. You have NewCo Re, once again, that cedes business through a variable quota share agreement to the transformer. That cession can also happen to be done to segregated accounts within the transformer. So there are a couple of different business models here, which I'll discuss a little bit later on. Tail risk is really the risk that the collateral and the collateral trust is inadequate to meet the needs of the retro agreement between a NewCo Re and the transformer. So if there's a shortfall, that shortfall falls upon NewCo Re's equity. We look at four types of tail risk. Type 1 tail risk is due to inadequate collateral based on the VAR level loss analysis. So we basically look at the VAR level losses, and then we look at how much collateral is in the collateral trust. If the losses are higher than the collateral trust, that's tail risk. So that's tail risk type 1. Tail risk type 2 is tail risk due to limited claims development period. So with CRs, claims development is limited, and so therefore capital can go back to the funds before losses are fully developed, which means that that the losses will then accrue to the NewCo Re, and so NewCo Re's capital has to take care of that tail risk. Tail risk type 3 is due to untimely posting of collateral. Going back to so when there's a reinsurance agreement between NewCo Re and the transformer, collateral has to be posted to satisfy that variable quota share agreement. If there's a lag between when that reinsurance agreement is entered into and when the collateral is posted, that's risk back to NewCo Re, because if a CAT event occurs in the interim, NewCo Re has to make up for that loss. So that's a third type of tail risk. Finally, the fourth type of tail risk is due to reinstatements. There can be multiple reinstatements in reinsurance transactions, 2 or 3 reinstatements. And if the capital is not there for reinstatements, then you also have tail risk back to NewCo Re. So these are all the tail risks that we see we can contemplate. Now, the easiest to calculate is tail risk type 1, which we'll look at now. There are a couple of business models we've seen in this space. One is a business model where the collateral put aside to satisfy the reinsurance transaction between NewCo Re and the transformer is commingled and available to NewCo Re. But the tail risk back to NewCo Re here is extremely muted because of the commingling and the diversification effect of the commingling. But to calculate tail risk, it is simply the formula you see there, which is tail risk type 1 is equal to the maximum of 0 and the difference of the VAR level loss and the total collateral. Once again, this tail risk is extremely minimal for business model with commingled collateral. That's not the case with a different kind of business model where we have segregated accounts. So if a business model with segregated accounts, for a business model with segregated accounts, we will look at a tail risk at the individual account levels. And so there's no benefit of diversification, right, due to commingling. So therefore, on the second bullet point there, we measure tail risk at the level of each account as the summation of the tail risk associated with each segregated account. This is the most severe view of tail risk because it assumes that there's 100% correlation across all the segregated accounts. We may change our mind if we get more information from rated entity in terms of correlations, but for now, we look at the summation of all the tail risks for each account. And so this business model is riskier than the prior business model for obvious reasons. Another important consideration in the rating process is the issue of alignment of interest between the parties, especially alignment of interest between the investment managers and, say, NewCo Re. So we want to know, first of all, how critical is NewCo Re to the operation of the ILS manager? And there are 2 sub-questions we ask about that. Is all the business that was flown through the unrated CR now flown through the rated CR? And will the weakened financial strength of NewCo Re damage the reputation of the ILS manager? If the answer is yes in both cases, it gives us an indication that yes, the interests of the ILS manager and NewCo Re are somewhat aligned. The other question we have to ask is whether there's any possibility of adverse selection of business by the investment manager to NewCo Re, and if NewCo Re gets all its business from the ILS manager, and the ILS manager has no other avenue to seed business, we can say that probably there's maybe no adverse selection on the part of the ILS manager. But if the ILS manager is a free agent, for example, it can place business here and there. You have to worry about whether NewCo Re will get the worst business than other reinsurers. So the idea of alignment of interest is absolutely important. We also look at the cedents themselves, and the quality of cedents matter greatly. And one of the indicators of whether the business being ceded to the likes of NewCo Re is good is how much risk is retained by the cedents themselves. The more risk that's being retained by the cedents, the more confidence you have the business originated by the cedents is good. We also expect investment managers to be asking a few other questions about the cedent's loss history, operating track record, as well as the claims handling abilities of the cedents. That has become a big issue after the last couple of years because it's been questioned as to whether some of the Florida insurers actually have prudent claims handling capabilities. We also, collateral managers should also be interested on how frequent portfolio updates and claim reporting is made after events occur. So these are all important considerations as it relates to cedents. We also look at some of the agreements, the variable quota share agreements, the funding agreements, and the trust agreements. The variable quota share agreement, once again, is the agreement between NewCo Re and the transformer. But buried within that agreement are some real juicy things like collateral release terms, commutation, clawback provisions, reinstatement provisions, and even buffer loss tables, buffer loss factor tables. These are all important things that can't be ignored and have to be scrutinized very carefully. And we do have a third-party legal review of some of these agreements in our analysis. The funding agreement, of course, also known as a subscription agreement, provides for how the collateral is, how the transactions are collateralized. This is an agreement between the transformer and the ILS funds. In that agreement, also clawback provisions if there's loss creep, for example. Of course, the trust agreement is a standard trust agreement between the NewCo Re, the transformer, and the trustee. All these agreements must be scrutinized extremely carefully, and we do so, as I said, by having third-party attorneys look at them. We also look at the availability of in-house expertise in our analysis. In-house expertise indicates how serious the venture is, obviously. And for us, some of the more important ones are listed here. The CAP modeling, of course, we need to know whether you have the infrastructure to actually model the risks, including modeling risks that are specialty risks. How many people do you have in the house to do that? Underwriting, of course, same thing. Claims reserving and business sourcing. We need to know what the infrastructure is, how many people are actually dedicated to this, before seeking the rating. Finally, we look at we have some rating constraints. As you know, there's some broad rating constraints on levels assigned to the building blocks as defined by BCRM for new companies. And these constraints are well defined in our criteria procedure called rating new company formations. The rating constraints may be loosened if the rating committee feels that the entity has substantive operational results and it simply just changes its business or organization license. It may also be loosened for other reasons. For example, if all the business previously undertaken by the unrated CR is retained and simply run through NewCo, or if the infrastructure has been in place for several years, including underwriting, modeling, reserving, ERM, and so on. These are indications that may let the rating committee decide that this is not considered a new company and may not be constrained in terms of building block assessments. We also look at stresses. We have potential stress scenarios we apply to the rated CRs. We have second event CAT stresses, which is well defined in our CAT stress documents, which Dr. Tang mentioned earlier. We may also stress based on TVAR. We don't believe VAR analysis is sufficient as a base. It's sufficient as a base case, but for stresses, we believe TVAR is more applicable to these companies that really deal on risk at the tail. So we look at TVAR in our stresses. We also look at Lloyd's realistic disaster scenario stresses, as well as special stresses for risks that are not well modeled, such as marines and other specialty risks. Some of these stresses hit available capital. Some may hit net required capital. Liquidity of the funds may be important if there are clawback provisions in the agreements. That is, if collateral is released early and the cedents want to claw back some of the collateral to satisfy the reinsurance obligations, we want to know what kind of assets are in the funds that can be clawed back. Generally, some of these funds have cat bonds available, and also they have maturing reinsurance agreements. Now, this doesn't guarantee that you'll get the money, because it's possible that investors will have flown the coop when the money is needed. But for most of the well-heeled ILS managers, they have a relatively stable funding base. But it's not clear what would happen if we have an extreme events, extreme cat events beyond what we suffered in 2017, 2018. It's possible that if they're gone, the clawback provisions may be worthless. But for now, we do look at the liquidity provided by the funds if the clawback provisions are in place. Then we also look at the reinsurance recoverables. The risk charges for reinsurance recoverables depend on the rating of the reinsurers, reinsurer counterparties, as well as the duration of recoverables. If the recoverables are collateralized, AM Best does give substantial credit to the risk factors, up to 90% of the risk factors. So collateralized reinsurance recoverables, I guess are assessed at very small amounts of risk charges. So then we're done with our formal presentation, and you can reach us at the numbers here and at the emails there as well.
Thank you, Manny. Thank you, Why. That was a very informative presentation. We do not have any questions from registrants. We will, however, let registrants know that a complete replay of this webinar will be posted within the next day or so, and we will have a full transcript out within the next couple of weeks. For AM Best, I'm John Weber.